Across Britain, a silent shift is shaking the foundation of the property market. Streets once buzzing with bidding wars now echo with for sale signs gathering dust. The dream of owning a home, once a symbol of stability, has become a financial burden for thousands. Behind closed doors, families are rethinking mortgages, sellers are slashing prices, and first-time buyers are hesitating. From London's luxury flats to small-town terraces, the same story unfolds. House prices are dropping fast, and few saw it coming. But the reasons behind this sudden fall reveal a deeper economic storm sweeping through the entire United Kingdom. Number 1. Rising interest rates. The sharp rise in interest rates has completely reshaped the UK housing market. When the Bank of England began increasing rates to tackle inflation, borrowing instantly became more expensive. For every small percentage increase, mortgage payments climbed by hundreds of pounds each month. Many families who once qualified for affordable loans are now locked out, forcing them to pause their buying plans. This drop in affordability has reduced the number of active buyers, creating a ripple effect that weakens overall market confidence. As mortgage costs climb, sellers face a new reality: fewer offers and longer waiting times. Homes that once sold within weeks now sit unsold for months. Some homeowners, especially those with variable rate mortgages, are struggling to keep up with payments and are forced to sell quickly. This creates distressed listings, adding downward pressure on prices. The emotional toll is heavy, with many buyers and sellers feeling uncertain about when stability will return. Economically, this shift marks a correction period after years of low-interest-driven growth. The cheap credit era made housing feel like a guaranteed investment, but higher rates have reintroduced risk into the equation. Experts believe these rate hikes are cooling an overheated market that was long overdue for balance. The combination of cautious buyers and desperate sellers is now driving a visible and rapid decline in house prices across the UK. Number 2. Decline in buyer confidence. Across the UK, buyer confidence has taken a significant hit, and it's one of the biggest reasons behind the sharp fall in property prices. When people lose trust in the market stability, they simply stop buying. Over the past year, uncertainty about the economy, inflation, and job security has made potential homeowners hesitant to commit. News headlines about a possible recession and falling prices create a self-fulfilling cycle. People expect prices to drop further, so they delay purchases, which in turn causes prices to keep falling. Real estate agents and developers are feeling the impact as foot traffic and inquiries decline. Even those with savings or pre-approved mortgages are holding back, waiting for the bottom of the market. This kind of hesitation freezes activity across the sector. Sellers begin to cut prices to attract offers, but with buyers remaining cautious, negotiation power shifts heavily away from sellers. The emotional tone of the market becomes pessimistic, where every new price cut feeds the perception of instability. The psychological effect cannot be overstated. Housing isn't just a financial asset, it's tied to security and future planning. When people feel the economy is unpredictable, they avoid long-term commitments. This erosion of confidence reduces demand faster than any government policy can correct. As confidence weakens, even strong markets like London and Manchester are seeing slower sales and softer valuations, marking a new chapter of decline driven more by emotion and uncertainty than by actual shortage or supply issues. Number 3. High cost of living. The cost of living crisis has become one of the most powerful forces dragging down the UK housing market. Everyday essentials, energy, fuel, food, and transport have risen sharply in price, leaving households with less disposable income. When monthly budgets tighten, saving for a house deposit or paying higher mortgage rates becomes nearly impossible. Even middle-income families who once dreamed of upgrading to larger homes are now focused on simply managing expenses. The financial squeeze has drained enthusiasm from the market and slowed the natural flow of buying and selling. This situation has also changed how lenders assess potential buyers. With higher household spending, banks are applying stricter affordability checks, rejecting applications that might have been approved a year ago. The result is fewer qualified buyers entering the system. Sellers now face smaller pools of interested buyers, forcing them to lower asking prices to attract attention. At the same time, landlords passing on higher costs to tenants are causing rent increases, leaving renters with even less ability to save for future homeownership. On a national level, the crisis highlights how deeply connected inflation, wages, and housing truly are. Rising living costs without matching wage growth weaken purchasing power and undermine confidence in long-term investments like property. For many, homeownership now feels out of reach, shifting public sentiment away from buying altogether. This widespread affordability strain is one of the clearest indicators that the current decline in house prices is not just a short-term dip, but a reflection of deeper financial pressure across the country. Number 4. Overvalued property market. For years, the UK housing market was climbing faster than most people's incomes. Property prices rose far beyond what average salaries could support, creating an overvalued market that was bound to correct itself eventually. Many buyers stretched their finances to the limit during the pandemic boom, fueled by low interest rates and intense competition. Now that those temporary advantages have disappeared, the reality is setting in. Homes that once seemed like smart investments are suddenly worth less, leaving owners facing potential losses or negative equity. This correction is not random, it's the result of unsustainable growth built over time. Government incentives, cheap credit, and investor speculation pushed prices beyond real economic fundamentals. People were buying out of fear of missing out rather than financial logic. With demand cooling, the market is adjusting back to realistic levels. The rapid fall we're witnessing is essentially the bursting of a property bubble inflated by years of hype and emotional buying. Economists view this decline as painful but necessary. It's a reset that could eventually make homes more affordable for younger generations who were previously locked out. While homeowners may feel the sting in the short term, the long-term benefit could be a healthier, more balanced market where prices align with wages and actual demand. The correction phase is a natural part of the housing cycle. What goes up too fast must eventually come down to balance itself.
Number 5. Surge in rental supply. A major shift is happening in the rental property sector, and it's having a direct impact on house prices. Many landlords are choosing to sell their investment properties due to stricter government regulations, higher maintenance costs, and new tax rules that cut into profits. As these properties flood the market, the overall housing supply increases while buyer demand continues to fall. This imbalance naturally pushes prices lower, especially in regions where multiple landlords are offloading homes simultaneously. At the same time, changing rental dynamics are adding pressure. With rents climbing faster than wages, tenants are finding it harder to save for deposits. This means fewer renters are transitioning into buyers, reducing the overall demand for homes. Meanwhile, the sudden rise in available listings from selling landlords gives buyers more options to choose from, encouraging aggressive price negotiations and further softening the market. The cycle feeds on itself. The more properties available, the lower the offers become. The shift also signals a broader transition in how people view housing as an investment. Real estate was once seen as a safe and consistent source of income, but the combination of taxes, rate hikes, and economic uncertainty has changed that perception. With landlords exiting and renters struggling, the UK housing market is entering a new phase where oversupply and weak affordability collide, driving prices down faster than many analysts expected.
Number 6. Drop in foreign investment. Foreign investment once played a crucial role in keeping the UK property market strong, particularly in major cities like London, Manchester, and Birmingham. For years, wealthy investors from Asia, the Middle East, and Europe poured billions into British real estate, viewing it as a stable and profitable asset. However, recent changes have dramatically reduced this flow of money. A stronger pound, rising interest rates, and higher taxes on overseas buyers have made UK property far less attractive than before. The result is a sharp drop in foreign demand that once helped maintain high prices. Another key factor is political and economic uncertainty. Since Brexit, investors have become cautious about the UK's long-term stability and growth prospects. New global opportunities, especially in markets like Dubai and Singapore, are now drawing attention away from Britain. Without consistent international capital entering the market, the luxury housing segment, which often influences overall property trends, has weakened considerably. Properties that once sold instantly to foreign buyers are now staying on listings for months. This cooling of foreign investment has a cascading effect on the wider market. When high-end properties lose value, it impacts nearby mid-tier markets as well. Domestic buyers see falling prices in prime areas and adjust their expectations downward. With fewer international purchases propping up prices, the market becomes more reliant on local demand, which is already struggling under inflation and affordability pressures. This absence of global buyers has quietly but powerfully accelerated the downward momentum in UK house prices. Number 7. Rising unemployment and wage pressure. The growing concern about unemployment and stagnant wages is further accelerating the fall in UK house prices. As companies face higher operating costs and weaker consumer spending, many are cutting jobs or freezing pay. This instability has left thousands of households uncertain about their financial future. When income security is under threat, fewer people feel confident taking on a long-term mortgage commitment. Lenders are also tightening approval standards, making it even harder for those with unstable jobs to secure loans. The result is a shrinking pool of qualified buyers, which weakens demand and drives prices down. For homeowners already struggling with increased mortgage payments, wage stagnation is creating deeper problems. Many are finding it difficult to keep up with their monthly installments, especially as fixed-rate deals expire and revert to higher variable rates. Some have been forced to sell their properties quickly, often below market value, to avoid repossession. These distressed sales contribute to the perception of a declining market and pull overall prices lower across surrounding neighborhoods. The broader economic picture adds to the pressure. Inflation continues to erode real incomes, meaning people can afford less even if their salaries technically rise. Businesses cutting costs and reducing staff worsen this cycle, limiting consumer confidence and spending. With both job insecurity and weak wage growth undermining purchasing power, the housing market faces a prolonged slowdown. Until the labor market stabilizes and real wages begin to recover, UK property values are likely to remain under heavy downward pressure. Number 8. End of pandemic-era incentives. During the pandemic, the UK government introduced several housing incentives that artificially boosted demand, such as the stamp duty holiday and the Help to Buy scheme. These measures encouraged thousands of people to rush into the market, pushing prices to record highs. But once these schemes ended, the sudden withdrawal of support left a massive gap in demand. Buyers who had taken advantage of these temporary benefits had already purchased, leaving fewer active participants in the market. Without these incentives, the true state of affordability quickly resurfaced. The stamp duty holiday was particularly influential as it allowed buyers to save thousands in taxes, driving a buying frenzy across the country. Sellers used this surge to raise prices aggressively, but now that the benefit has expired, there's little reason for buyers to pay inflated rates. Many are choosing to wait, expecting values to drop further to reflect real economic conditions. The disappearance of government-driven momentum has left both agents and developers facing a much slower pace of transactions. This shift highlights how dependent the housing market became on short-term policies rather than organic growth. What once appeared to be a boom was actually a temporary spike fueled by incentives, not genuine affordability or wage improvement. As those supports fade, the market is now correcting itself to align with real-world purchasing power. The end of these pandemic-era programs exposed the underlying weaknesses, high prices, low savings, and rising debt that were hidden beneath the surface during the boom. Number 9. Increase in housing construction. During the housing boom, developers across the UK began launching large-scale projects, expecting demand to keep rising indefinitely. But now, as economic conditions tighten, many of these new builds are being completed and released into a market where buyers are scarce. This has created a situation of oversupply, especially in suburban areas and commuter towns. With more homes available than people ready to buy, prices naturally begin to fall. Builders, facing high carrying costs and loan repayments, are offering heavy discounts and incentives just to keep sales moving. The rise in construction was initially seen as positive, helping to solve the UK's long-standing housing shortage. However, the timing has turned against developers. Mortgage rates have soared and consumer confidence has collapsed. Many potential buyers who had reserved new homes are backing out before completion, leaving developers with unsold units. To recover investment quickly, these firms are cutting prices aggressively, pulling down the average market value in entire regions. This is particularly visible in cities where multiple construction projects overlap. The consequences ripple through the broader housing ecosystem. When new build prices drop, existing homeowners nearby are forced to lower their asking prices to remain competitive. Real estate agents report growing pressure to price realistically as listings pile up. The result is a feedback loop. More construction adds supply, which drives further depreciation. Until demand stabilizes and excess inventory is absorbed, the oversupply of housing will remain a critical driver behind the UK's rapid and ongoing fall in property prices. Number 10. Global economic factors. The final and perhaps most far-reaching reason behind the sharp drop in UK house prices lies in the broader global economic climate. The world is facing a combination of high inflation, supply chain disruptions, geopolitical tensions, and slower growth, all of which have indirect but powerful effects on the British property market. When global investors become cautious, they pull money from riskier assets like real estate and move it into safer investments such as bonds or commodities. This global shift away from housing has weakened demand in the UK, particularly among large institutional and overseas investors who once dominated luxury property purchases. The ongoing conflicts in Europe and the Middle East have also contributed to rising energy costs and global instability. These pressures fuel inflation, forcing the Bank of England to maintain higher interest rates for longer periods. As borrowing costs remain elevated, both domestic and international buyers delay purchases, expecting prices to fall further. Global uncertainty reduces confidence, and real estate, often seen as a long-term commitment, suffers the most when investors fear volatility. Adding to this, the global slowdown in trade and investment affects Britain's export-driven economy, putting pressure on wages and employment. With less income growth and fewer foreign inflows, the property sector loses a critical source of liquidity. Every factor, from rising oil prices to shifting global interest rates, contributes to this environment of caution and contraction. The UK housing market, once seen as resilient against global shocks, is now moving in step with worldwide trends, reflecting how deeply interconnected today's financial systems have become. The UK housing market is undergoing one of its most dramatic corrections in decades. What began as a slow adjustment has turned into a national reset, fueled by rising interest rates, shrinking confidence, and a cost-of-living crisis that's testing families across every income bracket. From overvalued homes to falling demand, every layer of the system is being peeled back to reveal how fragile the boom years truly were. Yet within this decline lies opportunity.
As prices continue to soften, the market is gradually moving toward real affordability, giving future buyers a chance to enter at more sustainable levels. For sellers and investors, this is a time to stay informed, think long-term, and adapt to new financial realities. The correction may feel painful now, but it also represents a crucial turning point, one that could bring balance and stability back to Britain's housing landscape. The question that remains is simple: how low will it go before recovery begins? If you found this analysis helpful, hit the like button, subscribe for more breakdowns of the UK's financial shifts, and share your thoughts in the comments. What do you think? Are falling house prices a warning sign or a new window of opportunity?